Inventory valuation is a crucial aspect of running a successful business. It's the process of determining how much your inventory is worth, and understanding this value can significantly impact your business decisions. Picture this. You have a store full of products, and every item represents money tied up in your business. If you don't know how much that money is worth, how can you make informed decisions about selling, pricing, or even restocking? This is where inventory valuation comes into play. Now, before we dive into the nitty-gritty of inventory valuation methods, let's take a moment to clarify what inventory actually is. Simply put, inventory refers to the goods and materials a business holds for the purpose of resale. It's not just a bunch of stuff on a shelf, it's a vital part of your operations. Without inventory, you can't meet customer demand, and without meeting customer demand, your business can struggle to survive. But hold on, having too much inventory can also be a problem. It leads to excess storage costs, potential markdowns, and cash flow issues. So finding the right balance is key. Now, is inventory a liability or an asset? That's a great question. Inventory is considered an asset because it represents future economic benefits. It's something that will help your business generate revenue over time. However, if you mismanage your inventory, it can quickly turn into a liability. Too much inventory ties up cash that could be used elsewhere, while too little can result in lost sales. So, striking a balance is essential. So, what exactly is inventory valuation? It's the process of determining the value of your inventory at any given time. This involves taking stock of what you have and assigning a monetary value to it based on various factors like condition, age, and cost. Knowing how much your inventory is worth helps you make informed decisions about pricing, purchasing, and even tax planning. It's your roadmap to understanding your business's financial health. Now, why do you need to value your inventory? Well, for starters, you can't sell something if you don't know its worth. If you're pricing your products blindly, you could be leaving money on the table, or worse, pricing yourself out of the market. Additionally, you can't accurately report your taxes if you don't have a clear understanding of your inventory's value. It also plays a crucial role in decision-making regarding production and purchasing. Knowing what's selling and what's not can guide your future purchases. Let's explore the 4 most common inventory valuation methods: FIFO, LIFO, weighted average cost, and specific identification. Each method has its pros and cons, and the right choice depends on your business model and inventory type. First up is FIFO, which stands for first in, first out. This method assumes that the oldest inventory items are sold first. It's simple and straightforward. If you're running a grocery store, for example, you want to sell the older products first to prevent spoilage. FIFO is advantageous because it provides a clearer picture of your profits, especially in times of inflation, as it matches the cost of older inventory against current sales prices. However, it can also lead to lower reported profits during inflationary periods, which might not look great on paper. Next, we have LIFO, or last in, first out. This method assumes that the most recently purchased items are sold first. LIFO can be beneficial for businesses that want to minimize tax liabilities during times of rising prices, because it allows you to match higher costs against current revenues. However, it can also create a distorted view of your inventory's value, as older items remain on the books at potentially outdated costs. Plus, it's not allowed under international financial reporting standards, which could be a deal-breaker if you're dealing with international clients or investors. Then there's the weighted average cost, WAC, method. This approach averages out the costs of all inventory items, regardless of when they were purchased. It's a great option for businesses with large quantities of similar items, like a manufacturer producing thousands of identical widgets. WAC smooths out price fluctuations, providing a consistent cost basis. However, it can be less precise for businesses with diverse inventory items, as it doesn't account for individual item characteristics. Finally, we have the specific identification method. This method tracks the actual cost of each specific item in your inventory. It's ideal for businesses with unique, high-value items, such as car dealerships or art galleries. While it provides the most accurate picture of inventory value, it can be time-consuming and impractical for businesses with large quantities of similar items. Now that we've covered the methods, let's talk about inventory errors. These can be a nightmare for any business. Missing products, inaccurate pricing, incorrect counts, damaged goods, and expired inventory can all wreak havoc on your bottom line. Regular inventory audits can help catch these errors early, but even the best systems can falter. The key is to stay vigilant and proactive in your inventory management. So, how can inventory valuation issues affect your company? Well, inaccuracies in your inventory valuation can lead to a distorted view of your financial health. If you overvalue your inventory, you might think you're in better shape than you are, potentially leading to poor business decisions. Conversely, undervaluing your inventory could raise red flags for investors and creditors. Accurate inventory valuation is critical for maintaining trust and transparency with stakeholders. When it comes to financial statement analysis, inventory valuations can cause significant problems. If your inventory values are based on estimates rather than actual costs, it can cloud the picture of your company's performance. Investors rely on accurate financial statements to make informed decisions, and inaccuracies can lead to a loss of confidence in your business. There are several factors to consider for accurate inventory valuation. You need to think about the condition of each item, market demand, lead times, and even the optimal order quantity. Each of these elements plays a role in determining the true value of your inventory. So, which inventory valuation method is best for your business? It ultimately depends on your specific circumstances. FIFO is popular for its simplicity and accuracy in certain scenarios, while LIFO can provide tax benefits in others. WAC is great for businesses with high volumes of similar items, and specific identification is best for unique items. Consulting with a financial advisor can help you determine the right method for your business. In conclusion, inventory valuation is a vital part of running a successful business. Understanding the different methods available and their implications can help you make informed decisions that positively impact your bottom line. Whether you're a small business owner or part of a larger corporation, mastering inventory valuation will empower you to navigate the complexities of your operations with confidence. So, take the time to evaluate your inventory and choose the method that aligns best with your business goals. Your future self will thank you.